Hi everyone, and welcome to another week of Learn It Live. Really glad to be coming every 2 weeks to you guys now. And today we're going to be covering intraday trading strategies, which will be exciting. So as always, I'm joined by Tyrone and Bella.
Hi everyone, welcome to tonight's episode. That should be a good one.
Yeah, so it's been a really interesting, week of trading or 2 weeks of trading. So we were talking about a few things last time, and quite a few. The break of the euro did happen, like we were talking about. And today we're going to be talking about some intraday trading strategies that we've used even this week to make a couple of pips. So that's really good. So as usual, I'd just like to quickly go over the risk warning. The information provided in these videos has been produced by third parties and does not reflect the opinion of Pepperstone. And of course, the information has been provided without any altercation or verification. I'll just leave that up there for a couple of seconds. Great. So what we're going to be covering today, we're going to be having a look at how to use EMAs more effectively. EMAs are a really good tool for us to use when it comes to intraday trading strategies or any quicker trading strategies. We're also going to be taking a look at the keys to price action and what to look for, and how to define candles and wicks. And how to define candles, while what we're going to tell you today seems quite simple, is actually an incredibly hard concept for a lot of people to understand. And I often find this is one that a lot of people overlook. So it's going to be a really simple answer for you, but you're going to see why the way that we define candles and wicks is really different from the way that a lot of people do it out there on the internet. And then of course we've got the Q&A, which we'll answer at the end of the webinar. So we really encourage, if people have questions that they want answered, feel free to put them in the chat, and one of the Pepperstone moderators will pick those up and we'll hopefully answer as many as we can at the end of the webinar. So stick around for that. And if you have a question, put it in there. And there are no dumb questions. I always like to make sure that everyone knows that. There's never a bad question. So I guess we'll jump right into it because we're going to cover a little bit today, and we're going to be taking a look at how to use EMAs. So I want to just quickly cover what EMAs are, from the standpoint of why we're going to use them, and then Tyrone's going to go a little bit more in depth into them. So exponential moving averages are one that we use, and the reason we use them is because they put more weight to recent price and more emphasis on what traders are doing now. And that becomes important when we're looking at something like intraday trading strategies, because if we're trading in the day and we're not trading over a longer term, we need to know what are the traders doing now, not what are the traders doing tomorrow, or what are they going to be doing over the next couple of weeks. Then of course, longer period moving averages are smoother than shorter period moving averages. This makes sense because of course, the shorter period moving averages are going to be going up and down a lot quicker due to the fact they're not covering as many candles or time. And you can always use moving averages to define trends. So we'll talk about that as something that we use quite a lot when starting to teach traders how to trade, and also when we're defining trend on shorter time frames. And then the last one we're going to be taking a look at to do with moving averages is that moving averages can also be used as dynamic support and resistance levels. And a lot of people overlook this one. So this is something that I think Tyrone's really going to break down tonight. So I'll hand it over to you quickly, Tyrone, and I'm sure you can explain to everyone moving averages.
Great. Okay, so just a very quick coverage of moving averages. I know a lot of people probably already know what they are, but when we're talking about fast and slow moving averages, we're basically saying that the bigger period moving average is the slower moving average, and the faster moving average is the smaller period moving average. So when you hear us talking about fast and slow, we're basically referring to the amount of time that a moving average, whatever it's defining it. So for instance, a 5 moving average and a 20 moving average, the 5 is going to be the fast one, just quite simply because it's being made up of the plots of the last 5 bars or candles that you're seeing on the chart. So it stands to reason that a 20 moving average is going to use the last 20 candles to get the plot price, which is going to make it considerably slower than the faster one. Now, a very common trading strategy, especially for scalping the intraday markets, is actually just trading the crosses, as we can see here. We can see that when the fast moving average crosses the slow moving average to the upside, we buy. And when it crosses from above the slow moving average to below it, you can sell. Now, of course, depending on what chart that you're on, you can be on a potentially 15-minute chart or a 1 hour chart. If you see any of these crosses throughout the day, more often than not, if you've got a very fast moving average like a 5 or an 8, for instance, as your fast one, you are going to see quite a few of these crosses, and they can be pretty reasonable in their return. So, it stands to reason, of course, that when you go out to a 4 hour or a daily chart, the crosses are a lot less. I guess they don't happen anywhere near as much, but the moves that they can produce when a trend actually does start can be quite significant. So it's all relative to the chart that you're looking at. So here we can see an example. A 5 and an 8 are a very popular fast-moving average number. We use them mainly because they're Fibonacci numbers. We do like to use Fibonacci numbers whenever we can. The 21 and quite often the 20 are probably one of the most popular moving averages, and you'll find that they're the ones that price reacts to probably the most, especially in the intraday markets, because even when you're looking at a Bollinger Band indicator, the center line on the Bollinger Band is a 20 moving average, and it's amazing how much price actually gravitates to it from the upside and to the downside. So we can see here that we've got the black and the grey moving averages. The grey can be maybe a little bit harder to see here, but you can see that the grey represents a 5 and the black represents an 8 moving average. And these are EMAs, like Thomas was mentioning earlier. An EMA moving average bases more weight on the front end of the number. So what we mean by that, if we're looking at a 10 EMA, more weight is given to the first 2 or 3 candles of the last 10, as opposed to a simple moving average where the last 10 candles in the sequence are actually averaged out. So that obviously makes it a little bit slower. The key to EMAs is that you do have to understand they can give you sometimes a bit of a false signal because they are so fast, because there is so much weight on the first couple of candles. They can react a little bit quicker, which sometimes give you, a false signal. But when a move does happen properly, you can see here when the grey crosses the black to the downside, you can see you're getting pretty significant moves in pretty even stages too. You can see that every leg of that down move is nearly equal. So, and you can see it never crossed back after it. And adding to the point that we were talking about with the 21 and the 55, you can see where the red and the blue crossed up the top end of the chart. You can see how long that actually stayed in a downtrend. So just to give you a bit of an example of how the bigger moving averages, when they do cross and there is a trend, how well you can actually get into it, especially if you do get the cross at the top.
Interesting fact about the 20 EMA as well, or 21. The reason why 20 or 21 is so widely used is when you think about it, how many trading days are there in a month? So if you went on a daily time frame, there's generally around 4 weeks or around 20 or 21 trading days. So the reason why the 20 or 21 EMA or SMAs are so widely used is because it does really represent, at least on the daily, a time frame of a month. And in our lives, obviously a month is very important, and same with financials. So because a lot of these trading systems or a lot of these trading indicators come from the stock trading world originally, that's where it really came from. It came from the trading days, and that made I guess the 20 EMA or 21 EMA a very popular number to use. And that similarly goes through things like the 55 and the 200 as well. So what I wanted to talk about just quickly here was dynamic support and resistance moving averages. So here we have a moving average on a chart. This is a Great British Pound US dollar daily, and we can see that while this is in a time frame, an up trending time frame, what's happening is every time it's pulling back, it's finding that dynamic support on this moving average. And even in that previous example, if we take a look at the different EMAs here, we can see that the 200 has acted as dynamic resistance, and several times the 55 has acted as dynamic resistance as well. And this happens very often, just like the 55 over here acted as dynamic support, it then acted as dynamic resistance and dynamic resistance again. And this is on the daily time frame. So EMAs are very popular because of this, because they can be used not only to figure out what trend we may be in and to give us an idea of getting into the market, but they can also be used as dynamic support and resistance to help us potentially find areas where we expect support or resistance to be, or second entries. So that can be really powerful with intraday trading strategies, like we'll put together a little bit of a trading system with you guys tonight. So let's just quickly take a look at the live market. I've actually given everybody a bit of a example straight away, and it's actually just worked out this week. So Tyron and I were looking at this particular trade, and this is where we've seen I'll just quickly delete some of these lines so it becomes a little bit easier for us to see. But this is what happened recently this week and last week in the euro. So we can see the euro reached back to the resistances at around this 117.30 kind of period or area. And then if we jump down to the smaller time frames, what we're going to see, because of course being an intraday trading strategy, we want to trade the shorter time frames, we can actually see a few things happening here. So firstly, and what we'll talk about in a minute, is change of trend to do with price action. But we can also see that this 21 and this 55 have crossed here, coming off our resistance point, and they've crossed to the downside when the market broke through this point here. And we'll come back to this chart in just a second once we've talked a little bit about price action. But the reason of this significance is it's coming off our previous resistance point. So this is where, as an intraday trading trader, what we can be doing is we can be saying, okay, we thought the resistance was up here. This could be our confirmation where that fast EMA has crossed back through the slow EMA and has given us that confirmation that now we can enter the short and we can get involved with this market. Tyron, do you have anything else to say about that one quickly?
Yeah, so just on the EMAs, when you're in a strong trend, like you can see here, the fast EMA is going to accelerate away from the slower EMA, and as you can see, price is actually showing that it's doing that. But as the EMA starts to slow down at the top of the chart, we can see that they're coming closer and closer together until they do eventually cross. And what that's telling us is that the momentum is actually leaving the market. So we're getting our first signal straight away that the market is starting to weaken, even though we consider it, a potential place of resistance. The market's giving us that signal from price action alone that the moving averages are getting closer and closer together, which means that the momentum is starting to run out. Once we get that series of lower highs and lower lows, and as you can see, it basically comes back. Yeah, you can see it comes back. Okay, sure. Yeah, you can see that it comes back all the way to, here we go. That's probably a more indicative way of seeing it. As you can see, it goes all the way back to the blue EMA, and just before it sells, it tries to push past it. But, the momentum of the market has already moved. So we're going to draw some lines on it now to show the lower highs and the lower lows, which is really the main thing that we're looking for. Whenever we're looking for a point of resistance or support in the market, we're always looking for that confirmation change of trend. And to do that, we need a higher high, a lower low, a lower high, and then finally a lower low. And once that happens, you can see that it came back and tested the moving averages again, just like Thomas was saying on that last point before it really dropped hard, and down she went. And of course, as soon as it's come down, it's found resistance again when it's tried to go past the red moving average down the bottom, and sold off again quite significantly.
Yeah. So this is that kind of dynamic resistance that we're seeing throughout this point here. But I just want to touch on this point about the price action of the lower lows and lower highs. So really, one thing that's really important for you guys to understand and to start to think about when you're looking at the market is that you want to see these kind of things happening before you enter trades. So a lot of people and a lot of novice traders will initially see this resistance here and they'll say 117.30, I'm going to sell that. And sometimes they're going to be correct, and that's great. But what actually a professional trader or a more seasoned trader is going to do is they're going to wait for confirmation reasons to get involved in this trade. And even as intraday traders, we really want to be looking for confirmation to increase our probability of being successful in the trade. So by seeing this high, this lower low, this lower high, and this lower low here, what you'll also notice is at the same time this point has hit a lower low and made a new low here, we've also got our confirmation that the 21 and the 55 have crossed. So we get that at the exact same time. And that's excellent because what we're seeing is we're seeing multiple reasons to start to think about getting involved in the short on this market. And that is what trading is. We're looking for multiple reasons to get involved. Never one, and you'll always hear us every Learn It Live. We're going to hit this every single time, aren't we, Tyrone? Multiple reasons to be involved in a trade. We always see it way too often. We train people, we talk to people, and they'll say, I have a great system. I use 7 different moving averages, and when certain ones cross, I get involved. That's great, but what about the other reasons? You need more than one, because big traders, they don't just use EMAs.
Yeah, the thing with trading just crosses of a moving average is you're going to get caught up in a lot of false breakups. It's called the ribboning effect is what we call it. And that's when a moving average, when the market is basically flatlining and the moving averages is constantly crossing each other. So when prices amongst the moving averages, straight away you know that you're either going through a change or you're going to go through a bit of a flat spot. Now, I'm not sure if everybody is aware, but I will just mention it just in case. The moving averages, when you do change between the charts, they do actually adjust for the chart. So a 10 moving average on a 1 hour chart is going to factor in the last 10 1 hour candles. But when you flick over to a 4 hour chart, it's going to use the last 10 4 hour candles. Okay, so they do automatically adjust to the chart that you're going through. And the patterns that we're talking about, and this is the thing, like when people are intraday trading, they say, do we use a 15-minute chart? Do we use a 1 hour chart or a 4 hour chart? It really comes down to the expectation. So you can see here that we're on a 1 hour chart, and yeah, we're getting a pretty significant move on the euro short. But yeah, this was actually predetermined in the 4 hour and the daily charts. Like this was a pretty good setup for the short well before this happened on the 1 hour. It just so happened that the 1 hour was the best time frame that changed the quickest, which enabled us to get in fairly early. But it really comes down to what your expectation is of each trade. So it stands to reason that a cross on a 4 hour chart is going to net you quite a bigger return than what a 1 hour or a 15-minute one will. So and whether you can say you can trade that in a day or in a couple of days, well, it really depends on the momentum of the move. Like you can see when the euro sells off hard, in this instance here, it's done in a matter of candles. So it's done it in 2 4 hour candles. You can see a couple of those big moves down, 2 big 4 hour candles. So that's happened in one trading session, or potentially half of one and half of another, throughout the European and the US markets. So the moves can happen even though you're looking at a bigger chart. Don't think that you can't trade intraday on a 4 hour or a 1 hour chart because they're bigger time frames. When the move happens, it happens good and proper. So we can see here that these moving averages, even on this 4 hour chart, we can see that they're coming very, very close together. And obviously the Euro USD is in a pretty solid downtrend now on the price action, because we've got nearly 3 or 4 lower highs and lower lows in sequence. And that's before the crosses even happen. So, when that cross does happen, if we do get another series of lower highs and lower lows and price comes up to touch the moving average, we can be pretty confident that, that the dynamic resistance that Thomas was talking about is more than likely going to hold, and it's going to send this bad girl down to 111.
Yeah, and another thing I just want to bring up just quickly, this is really our key level here, or becoming our key level for a break. If it does break underneath kind of these bodies here, we could be expecting even lower point, as Tyrone said, so at least down to that 113, potentially 111 area. Now, as intraday traders, what we're looking for is we're looking for these key breaks. So what you'll notice is look at what this 4 hour EMAs are doing. The 21 has not quite crossed the 55 yet, but if it does cross, what's probably going to be happening at the same time as it crosses? You're going to be breaking that key support zone. So it always, just like we saw in that 1 hour where that change of trend happened, often these EMAs are going to be showing us the same thing. And that's the importance of reading price action with the EMAs. We're bringing 2 and 2 together. Now I'm going to quickly quiz a few people here in the webinar. You'll see this particular candle here, and some people will know what this kind of candle looks like, but this is a very important candle, especially when we've already ascertained what we want to do with this trade and that we want to be involved with the short. So it's not always a perfect kind of scenario in the real trading world, but this is a candle that we're going to be talking about. We're going to be talking about how to define that in a minute. So just quickly, like to jump back into the slides and go into another key resistance support kind of concept to do with price action, and that is the concept of role reversal. So a lot of people don't use this, but swing traders, intraday traders, we should be using this. It's very, very key for us to have successful trades. And that's the concept of this role reversal, where we've got resistance, gets broken, and then becomes support, and vice versa. If support was broken and the price was coming down, and then the support was broken and it comes back up and it tests at that level, and that level becomes resistance. And this happens time and time again, doesn't it, Tyrone? This is probably one of our most successful things.
It is. It's definitely because it's the thing that everybody sees. And although not everybody trades role reversal in its true form, most people can see static resistance and static support on a chart when it is, very obvious. All role reversal does is really solidify what the support will be after resistance and what the resistance would be after support in a downtrend. Now, a common question we get asked is, what's more important, support or resistance that are static like we've got here, or dynamic support and resistance? Look, they're both equally important. The dynamic is very, very important because that's really the here and the now, and that's actually moving with the market, where static support and resistance is using the history to give you the zone. So you're basically looking at what's happened in the past. But as we all know, sometimes what happens in the past doesn't really dictate what's going to happen in the future. All it does is give us a bit of an idea. Whereas the dynamic support and resistance that comes from the moving averages is really giving us the price action and the trader's sentiment to what's actually happening in the now. So they're as important as each other, but when you've got both of them working for you and you can see a reason to sell or buy, even on the smaller time frames intraday, and they're both agreeing with each other, that's when you've really got, a real bonus when you're putting your trade plans together, because both of them are really, really important.
And a good example of this, I don't have this on the slide here, but it would have been nice to have. If you did have, let's say, a 21 and a 55 on this particular 4-hour, because this consolidated for such a long period of time, it is theoretically possible that the 55 or the 21 EMA would have actually been sitting here as also dynamic support at the same time just before the market moved off. So something like that can also happen and can help us with our support resistance role reversal examples. Yeah. But as
and
Ty
in a situation like that, when in that situation like that where the market has moved sideways for certain, for a certain period of time, you can almost be assured that at the very least the 20 moving average would be there. EMA or SMA, it wouldn't actually matter. Both of them would be right on the price action, because you've had 20 or 30 candles all in a row that have really slowed down the momentum there. So there's a very, very high chance that will happen, and we'll see if we can see that in a live example shortly.
Yeah, excellent. So the theory of role reversal, very, very important. Obviously, the clearer the resistances or the supports before, the better usually the role reversal is. So if you see something like this where you've got 4 resistance points being hit, yes, it takes a little while to take off, but obviously this is a more successful, higher statistic type of trade. And even just little things that people don't pick up on. If you see, again, this break happens, see how there's this little bit of consolidation on this 4-hour before it breaks through. This is often what you see. Just before the break, if you see this nice consolidation where kind of the market's wrapping or coiling, getting ready to break through, and then breaks through with such aggressive force, that usually means also, if it does come back down and test, that the role reversal is going to be a successful type of trade. So let's just quickly jump back into the charts again, and I want to take a look at the odd USD recently. So I think that's been an interesting one. A lot of people are talking about it here in Australia. So just quickly want to talk about it. You can see here a little bit of dynamic resistance. It breaks through a bit, but this has been keeping it in this 55 on the daily. What does happen down here though is what's key. So you'll see that support was formed around this 0.7355 area, and then the market broke through and it came back and it tested that what was previous support becomes resistance. And it took a little while, not too long, but there are some big moves in here. I mean, this initial short was over 100 pips, and then of course now it's gone a total of 180 pips down. But what we're looking at is we're looking at this theory and we can say, okay, we've got that kind of maybe potential dynamic resistance of the 21. We've got our role reversal happening here. Let's see if we can find another reason to be potentially involved with this trade. So what I like to do and Tyrone likes to do is we like to jump into the smaller charts and start to look for potential key reasons for us to see that change of trend happening, whether that be on a 1 hour, a 15-minute, whatever time frame, for us to get into an intraday type of trade. And what you'll see just up here is a very similar candle to what we were talking about before. And we're going to jump straight back into the slides. We're going to take a look at some candles and how to define something. And then we're going to talk about this particular candle, because this is one of the things you see all the time in the market, and it means so much more than just this little candle by itself. So what are these candle bodies and wicks? So you'll see here that we have, some people will see things like inverted hammers, you'll see engulfing candles, all sorts of things. And then of course you've got what they call the hammer and the shooting star. So in this case, we've actually seen two shooting stars. And usually a shooting star, how it's defined is you'll see a large wick followed by a smaller body. And generally, a lot of people always think it's going to be a bearish body, but that's not really the important part, is it, Tyrone? What's the most important part about these candles and wicks?
Okay, so the most important part on a shooting star and a hammer for that matter is that the body of the overall move is only 20% of the whole candle, or basically bar, because you can have a bar that looks the same. So what we mean by that, we can see here that the body of the shooting star only makes up 20% of the overall length of the range of that bar. Okay, that's what makes it a solid shooting star. That's what, if you add that rule and just have that 20% rule, it takes away a lot of ambiguity as to what a shooting star is or isn't, because sometimes the body can be, you know, a third of the range, or it can be half of the range, and people just call it a shooting star anyway. That's actually not a shooting star. A shooting star needs to have only 20% of the body of the overall range of that particular candle to be effective. And it needs to be in the bottom 20%, of course. So why is this candle so important? Oh, okay. This candle is so important because what it's shown is that the buyers have really attempted to go very, very hard and continue the upward momentum of this little short-term trend. Okay, but by the time the candle has finished, we've had the sellers come in and completely reverse what the buyers have done, and brought it all the way down to the bottom 20% of the overall range. So although the buyers have sent a pretty clear message that they were trying to long it, the sellers have actually taken control of that candle at some point during the period and won that little mini war. Okay, so that's why it's a very bearish candle. So we can see here, there's a couple of very good examples here.
Yeah, and when this is combined with what our already known bias is due to our EMAs on the shorter time frame and our change of trend in terms of higher, lower lows and lower highs, when we're combining all of those together and then suddenly we see a candle like this one here that we were talking about before, what do you think that signifies to us? It signifies let's get in and let's go short. Doesn't it?
That's right. Look, a shooting star in the middle of nowhere, in the middle of a range-bound market, doesn't really hold a lot of significance for us. But when you see a shooting star at a place that we would expect resistance, with dynamic resistance coming from an EMA and potential static resistance coming from a roll reversal zone, that's like winning the lotto. Like you're getting all these really, really important reasons why the market is going to do what you think it's going to do. Whereas in isolation, a shooting star in the middle of nowhere with no real backup doesn't really mean that much. And it really comes down to what Thomas was saying before about an EMA cross. An EMA cross in the middle of nowhere, you know, without real momentum in price, doesn't really mean as much unless it's in an area where, you know, we are expecting a reversal of some sort, whether it's to the upside or to the downside. But just as importantly, getting that candle confirmation, because we must remember that we can put all the indicators we want on the chart, but the most important indicator of them all is price, and price is often overlooked. And what I mean by price is actually candlestick patterns and candle action. So that's the number one indicator that you really need to look at first and foremost. Other indicators like EMAs and Fibonacci's and, you know, support and resistance zones come later. They're really just giving you the idea of the area, but price dictates what's going to happen next. So that's one that really, really can't be, you know, understated.
And I think another important thing just about these shooting stars or hammers or candles is that, as Tyrone alluded to, it's not that they're super high statistically correct. It's when they're in the right area, the meaning behind what's happening. In these cases, price has tried to move higher, it's been rejected, the buyers have lost control of the market, the sellers have regained control, and they've pushed it right down. And you will see these shooting stars and hammers start to appear in places of role reversal. They'll start to appear on your dynamic support resistance. They'll start to appear on changes of trend where you've got the market coming back or the market testing a point. And they'll often happen because they are actually stop hunts as well. So, the bigger traders in the market, they'll look for areas where they'll know you may have a stop. They may know that you've taken a sell here and maybe you just don't have the correct stop loss. And then they'll push the market a little bit further. It'll hit you out. Nothing more frustrating in trading than being hit out and then being proven correct over the next 2 hours that it does go in the right direction, and it'll go in your direction. Of course, you should have had those pips. The easy thing about these as well is if you do find shooting stars, what can we do in terms of trading them? We can look at putting the sell order in. We don't just press sell order. We don't just say, okay, I'm going to sell this market right now. We actually place the stop or the sell just below the low of the wick so that we make sure on the next candle that it does continue in the direction. We don't know if it's going to close and keep going in that direction, but at least we're giving it every shot we can to say it must keep going in that direction. And then, of course, with our stop loss, we can just, confirmation's key. What do we talk about every week? We always say that. And then we can place our stop loss above the wick or above the dynamic support or resistance. That's the cool thing about this. We can find different ways of placing our stop loss, but we get our entry points. And it can be very high rewards.
Absolutely. So I just want to touch on, even in the smaller scale, if we just see the very last cross on where the red is crossed below the blue the last time on this chart, you'll notice the candle prior to that, the little doji candle is what we call a doji candle. The indecision candle there. So even there, when we can see clearly well before it happens that the red is moving very close to the blue. So the fast moving average is losing momentum and quickly gaining ground on it. And pretty much just before it crosses, the candle just before it crosses is a doji candle. So what a doji candle is, it signifies uncertainty in the market. So it's opened and closed basically at the same area, even though buyers have pushed it up and sellers have pushed it down, it's effectively closed at the same area. Okay, the very next candle is where the cross happens. So we already know at that point that we're bearish on the market already. We've got indecision on the price, and then we get the cross. So it's all these little things together that give us a clue that we should be either shorting or longing in the direction of the trend. Trend is obviously the most important thing, and identifying that is the number one key to make sure you're trading in that direction. But there's many little cues, and a lot of them are to do with price or a price candle pattern that will show us that the indicator is actually strong. Whereas, and it's even with the other one, we can see the cross previous to that where the red crossed from below to above the blue. I'm sure everybody knows what that little candle pattern is. It's an engulfing. Okay. Now, although it didn't go a lot of pips, this is a 4-hour chart. So I think if we measured that out, I think you'll probably find how many pips is that, Thomas? What do we got there?
Just under 30.
So most day traders who are scalping the market, from a lot of the education that we do with students, most people are looking for anywhere between 5 to 15 pips. So a 30 pip move would be a bonanza for a day trader who are looking at scalping every few minutes. So you can see that even in that instance, when a candle pattern is backed up by a cross of a moving average, it actually just adds a lot of strength to that move.
And what we can do is we can go down and proof those kind of things on the smaller time frames, look for our crosses, look for other things. So that's something that we can always look for. All right, well, one other thing I just want to quickly mention as well, just while Tyrone was talking about those dojis and things about dojis and candles in general, is often we will see those kind of candles appearing at our points of resistance and support. So you can see here we have another long leg doji. We have that small body in the middle. We have that indecision candle, and guess where that indecision was formed? Right around the resistance level that we expect to be a problem. So while this doesn't meet up with our EMAs in this case, what the candle is telling us is the market knows that this point is a point that's going to be, well, we're not sure what's going on. Let's see what happens. So then even when it's starting to tell a story that we're looking into, so we see this long leg doji, we see that movement in the price action, and all of a sudden, well, we're pretty interested in potentially being involved with this trade because the story is starting to make sense. And a lot of trading is a story. Do we have enough reasons to be involved? Is there a story backing it up, and is the story going to continue? Because getting into the trade and getting and becoming good at finding the trades is only part of it. It also then comes into, can we stay in the trade? Are we seeing the confirmations we want? Let's just say we entered the trade at this potential point here, and we might have had a stop loss above here and a take profit down at this level here. We're starting to potentially get a little bit worried as it's coming against us, but then we see this candle here, and then we go, ah, thank goodness. We're still maybe down at that point, but would you be feeling a lot better about the trade, Tyrone?
I'd be feeling very comfortable about that trade, Thomas.
I think indeed. So that's the thing. Well, you know, we laugh, but a lot of guys that we train, what's their biggest problem? It's not even just pulling the trigger and getting involved in the trade. It's keeping it in.
Yeah. But look at that. I mean, that shooting star there is a perfect example of what we're talking about. Like, the buyers have pushed it well above the EMA that we can see there, and the sellers have brought it all the way back down below the EMA, or just on the EMA, just to really highlight the point how strong the EMA resistance is there. Like, that dynamic resistance is holding, and it held a pretty big advance from the buyers for the sellers to bring it all the way down back underneath it, and then obviously it sold off after that. So that's a very positive sign, and that's why, all jokes aside, I'd be very comfortable with that trade if I was short, because it's a very, very good indication that the market is going to do what we expect it to do at that point.
So let's just quickly jump back into the slides for a second. I just want to go over something that we always talk about but cannot hammer it home enough. Sound risk management strategies. We always have to have them. So obviously be smart with your risk reward strategies. I think I almost talk about this every week, 1 to 2% of capital if possible for new traders. It's really important to not risk too much per trade. And then, of course, when you're getting involved with trades, always think, where does my stop loss need to be? Be honest with yourself about that, and then try to look for trades that are giving you 1.5, 1 to 1, 2 to 1 risk rewards. A lot of guys we train, they often go with this 0.5 to 1, and what that means is that they might risk $100 and only make $50. So it's really important for us to be risking $100 and trying to make $200 or $150. That's very, very important. Know when to get out and have a plan for all situations, something that we've talked about for a few weeks as well. And of course, I always say identifying stresses is important, because a lot of new traders, they'll maybe risk a little bit too much, or they'll be looking at their phone during the day and they'll make mistakes because of that risk, or they might have a meeting and they'll actually perform worse in life. So just always identify that and try to trade outside of those times that you know are going to happen. And I'll put this one over to Tyrone, because we talk about this a little bit recently, but it's because it's just so important.
It is, and it's important because it touches on a lot of the things that we've talked about tonight, that we're basically covering off a lot of the bits and pieces that we're looking at to make a decision on a trade. Now, Presic is our proprietary trading planning system that we use all the time here. And just to go over it a little bit on what we've talked about tonight, when we say price action, we're talking about the change of trends of the higher highs and the lower lows, and basically the price action candles that we were talking about earlier. So the shooting stars, the engulfing patterns, those sorts of things. That's what identifies the P. The risk management Thomas just touched on. The ELD 363 system is our multi-time frame system. So that's what that refers to what Thomas was alluding to earlier when he said we can look at the daily and the 4-hour chart and see a pattern emerging, and then go down to a smaller time frame to identify an opportunity to go in, whether it's a candle pattern or a sequence of lower highs and lower lows for a downtrend, or higher highs and higher lows for an uptrend. Chart patterns, we haven't really looked at any chart patterns tonight, but chart patterns refer to things like double tops and bottoms, head and shoulders, triangles, all of the good things that we love to trade. Indicators, of course, we've touched on those. The EMAs and the SMAs are what we talked about tonight, but there are many other indicators that are out there. We only use a handful, but things like MACD, stochastics, depending on the situation that you're in. And charting techniques, which are basically the role reversal that we were talking about, the support and resistance, Fibonacci, all of the things that actually you can use as a technique on the chart that isn't specifically a pattern or an indicator, but it's giving you an idea of what the market may do. So a lot of people, another common question we do get asked is Fibonacci dynamic support or resistance? The answer to that is yes, because when you draw a Fibonacci retracement line, when you're marking out, say from a high to a low, you are measuring what's actually happening in the market right now. So it is actually dynamic support and resistance because it's giving you levels on the move that, or the most recent swing high or swing low. So static support and resistance is price points from a historical standpoint that have been support or resistance in the past. Anything that is measured on a moving market like Fibonacci's or moving averages are dynamic support, okay? And like a trend line is also dynamic support. So just keep that in mind, that anything that is moving and adapting to a moving market is dynamic, and anything that is restricted to fixed prices is static.
Okay, well, I'd just like to, I guess, hand it over to Marco, I believe, from Pepperstone, and see if you guys have any questions that we can answer now.
Hi guys, thanks a lot for the webinar. Yes, we do have some questions. Well, actually, the first one you just answered it because it was our Fibonacci reversal, an example of dynamic support. So that's, I think that's answered. So
I feel like Tyrone saw that.
Yeah.
Oh, good. Okay.
So we'll go on to the next one. The next one is, I'm using nearly the same periods for moving averages, but I use the simple moving average. Will there be a huge difference in between those and the EMAs?
Not a huge difference. As we explained, the EMAs may be better for, I guess, intraday trading strategies because we are very interested in waiting on the most recent candles. So as we explained, EMAs are good if we're looking for scalping intraday, quick moving markets, and SMAs are maybe better for our longer term trading. So yeah, not too much.
The best way to see the difference is to pop them both on your chart. So pop a 20 EMA and a 20 SMA on your chart, and you'll see how quickly the EMA moves compared to it. But for scalping strategies in particular, you definitely want to be using the EMAs.
Yep.
Perfect, thanks. We'll move on to the next one. So the next one is, may you kindly explain the phrase you just said, you can trade the 4-hour chart as an intraday trader, and may you show us an example?
Yeah, so in terms of being able to trade the 4-hour chart, so if you're trading a 4-hour chart, I mean, probably this is as good as example as you get. When you're talking about, a lot of, obviously 4-hour charts, a lot of swing traders are on that, but intraday traders, we don't want to be in it for too long. When you're talking about getting into something and being out quickly, when you do see things like shooting star and hammer candles, because they signify a change in trend, being that the buyers have lost control and the sellers have gained control here, and we already know that the trend should be down on our lower highs and lower lows. When you see this, usually the move is going to be aggressive. And just like on that Australian as well, often the move will be semi-aggressive. And remember, this may not look like that much, but if we're getting involved with a trade here and our stop loss is only 22 pips above and it's going 28 pips, well, that's already over a 1-to-1 for us. So that happens within our intraday. That happens quickly enough for us. I mean, Tyrone, do you have anything else to say about that? I think candles probably going to be the big key.
When you see the candle forming on a 4-hour chart like that, so I think what he's alluding to, the question is, how do you trade that on a 15-minute chart or a 1-hour chart? Well, quite simply, when you see a weakness in a 4-hour chart like we just saw, when you go back to a 1-hour time frame or a 15-minute time frame, you're going to see a whole series of lower highs and lower lows, very similar to what we've drawn here on the 4-hour. And they're your keys to get in, because you know already that the bigger time frame is negative. So we're looking for a selling move on the bigger 4-hour time frame, which is going to give you many smaller moves or many smaller opportunities to sell it down on the 1-hour and the 15-minute. Probably the 15-minute more importantly on a 4-hour, because I mean there's only 4 1-hour candles in a 4-hour candle anyway, so you're not going to see a significant shift in lower highs and lower lows. But on a 15-minute, where there's 16 candles in a 4-hour chart, there's definitely scope for a lower high and a lower low to form. And And also, like we said earlier, when you drop down the time frames, the moving averages change as well. So you're going to get a lot more touching of that dynamic support or resistance depending on what direction you're going in. So you're getting a lot more opportunities to actually sell. So that's what we mean by intraday trading. The bigger time frame just gives you many opportunities on the smaller time frame because you've already got a bias.
And that bias, as Tyrone alludes to, maybe here what we've got is we've got this engulfing candle, 15-minute engulfing candle. That's a sell signal coming off dynamic resistance.
Yeah.
It's a sell
Look how many
signal.
times
That's
it's
what it
touched
is.
a 20. It's touched a 20 3 or 4 times and sold off every single time. And that's all been brought about by the shooting star that we saw earlier on the 4-hour.
And the best thing about this is we've got that extra confirmation coming off the dynamic resistance. And as intraday traders, the best thing about this, we place our sell, we put our stop loss in at 19, and potentially we could be taking out of this trade around 47, 48 pips. So it can be very successful. We need to get our biases, though, generally on that bigger time frame, like the 4-hour. It's a great question.
That's good, thank you. So another question that we had, in one of your first charts that you had up, it was the Aussie dollar chart. We were talking about EMAs, and we saw that after the cross, there was a price. The price was going up instead of going down, and then it went down real fast. Is that normal?
Okay, so I assume we're probably talking about the 4-hour, and we're talking about the cross here where the price went far down and they crossed maybe here. Is what they're talking about? Not sure.
Yeah, I mean, I've seen it when they wrote the message, so I think that was the case, but I'm not quite sure on which chart it was.
We'll have to assume it's here. The important thing about having more than one reason to be in the trade is that there needs to be more than one reason to be in the trade. This particular chart here, we have a bias towards the short because the price action and the role reversal is also telling us let's get involved with the short side. So if we go back to that daily, what you'll notice here is look how long this cross has been involved. It's very long time that this 21 has crossed the 55 and been in the short. We also know that when this level broke, and this is why price action is the number one key indicator that we love to use, when this broke, it's probably going to come back and potentially test this level, and we've got that dynamic resistance on the 21. So as intraday traders, we really need to be a little bit more biased towards the short side because the bigger time frame again is telling us let's be biased towards the short side, and then we're looking for the crosses to the downside. Unfortunately, EMAs, while they're great when you put them together with other things, as Tyrone alluded to before, sometimes they can do this and they move in a sideways market and they trap you constantly and you're not going to be very successful. So the key is to get your bias off something like price action, role reversal, change of trend, those kind of things with price action, and to build your EMAs around that.
Only take the crosses in the direction of the trend. That's basically the number one rule for moving averages. Just only take crosses in the direction of the overall trend, and your chances of success increase dramatically.
And again, I just want to bring up this, and the reason we really stick to dailies is that holds true to exactly what we were doing with that euro US dollar to the short. While price might have been above these EMAs, look at where the cross was. The cross still hasn't happened to the upside. So yeah, take price. We love day, looking at the day ones, and then of course we go down to the smaller time frames and make some trading decisions there.
Good. We have one last question, if you guys may.
Sure.
So it's pretty easy, but just and it needs an answer. With the 21 and 55 EMAs, are they recommended for all currencies or just the majors?
Okay, so look, we recommend we use them for everything. It's not just the majors and the minors. We use them for the stock market. We use them for indices, gold, silver, oil, everything. And the reason for that is because everybody does. Okay, so the thing with EMAs is what we want to be seeing is what everybody else is seeing. The most important thing is to actually not try and recreate the wheel. We want to be working with the market. So we don't adjust our EMAs at all. We never change the numbers because we know that they're the most popular. And like Thomas said earlier, the 20 has significance because it is based on a 1 month's worth of trading on a daily chart. as is the 200 and the 50. The 50 is basically 3 months of trading, and the 200 is like 6 months of trading. So there's significant points in themselves, and the 5 is also important because that signifies a 5-day week. So a 5-day trading week is what the 5-day moving average is basically showing. So when you drop it down the different time frames and you swap between currencies, majors, minors, or anything else that you're trading for that matter, it doesn't really, you don't really want to be changing that too much. Okay, so another question that I did notice that has been asked a few times, is this being recorded? Yes, it is. So for all of you people who had a little bit of trouble keeping up or want to go back and just refresh what we've talked about, just talk to your Pepperstone representative if you don't get a copy of the replay, and they'll be able to point you in the right direction in that one, and you'll be able to see our previous webinars as well, so you can go through and see any of those that you haven't been able to catch up with.
And just one last thing before we end up, I just want to always reiterate to people that we will be doing a free workshop at our Melbourne venue, and that will be coming up on September the 19th. So if you visit fxevolution.com/fxevolution workshop, you'll be able to sign up for that. We'd love to have you there, and we'll be sending out invites next week to everybody. So it's free. It's going to be for 2 hours. I think you guys will get a lot out of it if you're lucky enough to live in Melbourne. Not voted the best place in the world, I think. It was.
Actually, no, winter's gone now. Melbourne is back to being the best place in the world. And,
oh, really? That's
if you live
the
in
unofficial.
the state, jump on a plane and come down. If you live in the state, it'll be worth it, because we're going to be talking in depth on how the pressing system works and why it's basically so successful in giving you quality trades, because it really delves deep into what we're looking for and touches on what we talked about tonight.
And the venue's pretty cool too. So we love having you guys here. We look forward to seeing you next time. And hopefully we've got some great Learn It Live topics coming up. So I think you'll find out more about that soon. So thanks everyone.
Thanks for your
guys,
time,
thanks
everybody. We'll talk to you next time.
Okay, speak to you all soon. Bye.